We are going to be talking about a specific piece of securities law. Securities, remember, are ownership, equity in your company or your venture. Now, this specific piece is called the 409A valuation. I have this conversation with clients frequently because the 409A, which is actually Internal Revenue Code section 409 subsection A, boring, is a very important section because it talks about the valuation of your company's ownership, the securities that you would give out or sell or grant or issue. This is a valuation required by that statute if you are promising equity to be given over time. So a common situation is a vesting schedule, also different types of ownership where you're giving someone some ownership or maybe promising that ownership, but they don't receive it until a later date. There's a very, wealth of different ways this can occur, but the most important thing to remember is that if you ever are going to give someone ownership and it's spaced out over time, there needs to be a valuation of your company done, because the way taxes work is that the valuation at the outset, when you promise them the ownership, and then all that period of time through which they accrue it or vest it or receive it, and then the time in which they eventually cash in on it or sell it, there is a tax basis for the difference, right? So the time between them, that value is presumably going to change, hopefully between when you issue the ownership and when the people ultimately receive all of it or sell it. The company has done really well and the ownership value has gone up. And so there's a difference in the value from start to finish. Now, the taxes are based on that. So when you do a 409A valuation at the outset, what ends up happening is you turn the presumption of that value from the outset. The presumption is that that value was correct because you did it through a 409A valuation. Meaning, like, who cares? Why is there a presumption? Who cares? What that means is that if at that later date the IRS wants to audit and say, we think the value was wrong and so we think you're making too much money off of that stock and we want to penalize you because you did an incorrect valuation. Well, in that situation, if you did a 409A valuation, it's on the tax office, the IRS or whoever it is coming in to do that and allege that it was incorrect. It's on them to prove it because the presumption is in your favor because you did a 409A valuation. If you just wing it and you just go, we've been around for a year, we have this much revenue and this much expenses, let's just call our shares 50 cents per share. And it turns out that that 409A valuation would have said that your shares are $3 per share. Big difference, obviously. And especially when you're dealing with millions of shares or thousands of shares, that adds up. And then as time goes on, if that value increases, it all adds up. And so that tax difference and that penalty could be pretty steep at that later date. Which is why anytime, again, you're giving ownership that will be promised, accrued, vested, whatever the case, in some interval over time, it is so important to have the valuation correct at the outset. And the best way to have that valuation correct is to undergo a formal 409A valuation. Unfortunately, these usually cost a few $1,000s, but if you do it, you could be avoiding tens of thousands of bucks later on. Now, the one situation in which you typically don't need to do a 409A valuation, but always do it if you can because it helps. Remember, the presumption is then on them. But the one situation in which it's not 100% going to be required and you probably are going to be okay is if your company is brand new. If you just started your company, meaning just filed your corporation or your LLC, and it's within the first couple months, maybe few months, you don't necessarily need a valuation at that time. I'm not using always here. Sometimes you still will, but most of the time in that situation, because the company is so new, you're able to assign a par value to the ownership, and then that will be sufficient and satisfactory if there's that audit at that later date to try to assess the difference in the amounts of the ownership cost and then the penalty or the taxes on that cash in later on. So, just to recap, 409A valuation, very important to have that done anytime you're going to give equity out on intervals over time, the most common situation being a vesting schedule. So, quicker video here. Hope it was helpful. 409A valuations. Don't know why I did a robot voice. Tune in again sometime for other topics. Thank you.